for a 10-day free trial to see our platform in action. Learn more at philsgang.com. That's philsgang.com.
Hi, I'm Phil Grande at philsgang.com. You know, I've been doing this business of trading over 55 years. God, they make it so complicated. It doesn't have to be. The best way to learn is to follow me, my actual investments. That's right. When I buy a stock, you follow me. Do exactly what I do. That's the best way to learn.
Check out the free 10-day trial. Learn more at philsgang.com.
Be my co-pilot at philsgang.com. Do what I do.
That's philsgang.com. If you want to invest your money and grow your wealth, listen to this.
Hi, I'm Phil Grande at philsgang.com. You know, I get so tired of listening to the same garbage every day, listening to the fake business news network telling you why you should buy this stock, why you should buy, and they're always wrong. Join my gang, philsgang.com, free for 10 days. You're going to learn when to buy a stock and when not to buy a stock. Hey, years ago it was different. You could buy a stock based on fundamentals. You could buy a stock based on earnings. You could buy a stock based on PE ratios. Those days are gone. That ended with QE. That ended when they financially engineered the market in 2008. Gone. Now you got to follow the money. And we have the knowledge because we have the chart. Pro 2 color code chart tells you when to buy, when to sell, when to run like hell.
For a limited time, you can join Phil's Gang free for 10 days.
Check it out, philsgang.com. Get the truth, get the knowledge, and understand how the market really works.
There's a lot of noise out there in the financial world. Bank failures, interest rates, bonds versus stocks. It's a lot. That's why it's important to find a voice of reason that can guide you through these volatile times. Phil Grande and philsgang.com is where you can find honest, helpful guidance to successful investing.
Get the knowledge and understand how the market really works.
And for a limited time, you can join Phil's Gang free for 10 days.
philsgang.com. That's philsgang.com.
When making wise investment decisions, Phil Grande has some sound reasons you should join Phil's Gang.
You know, when I started this, they asked me, okay, can you explain to people why they should join the gang? Gee, I thought about that. And I guess to make money. But more than that, to get good direction on which way the economy's really going. We get so much crap, so many lies, how great the economy is and how great the tech business is, and when it's not. The problem is we have too many people in Washington and in this industry that just don't tell the truth. The truth is everything. And here at Phil's Gang, we stick with the facts. We tell the truth. We make sure our members, are getting the best information, and our listeners, like you. We make that information available to you and make it simple and understandable.
Good investing means understanding how the stock market works. Join today at philsgang.com. The stocks discussed on Phil's Gang are not in any way a recommendation or solicitation to buy, sell, or hold. If considering acting on information presented, we first recommend you seek out a competent, licensed professional for advice. Get ready for the radio show that tells you what Wall Street doesn't want you to know.
Oh, I'm a money magnet. Money's coming to me. Money sets me free. I'm a money magnet. Money's coming to me.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Radio Network. With your host, Phil Grande.
And welcome to Phil's Gang Podcast and Radio Show. Okay, we've been saying all along, you got to be careful. I've said that the market is going to have a crash. But I also said, in the meantime, they can continue to run this market, the S&P, up to around 6,200. But there's going to be a lot of headwinds. And once the retail investor runs out of money, then we're going to crash. And we're going to go over some of those with you today, tell you what's going on. Going to go over the banks with you. But let's start with what's really going on. Everyone's following the noise instead of following the money. If you follow the money, you've been prepared for a day like today. Now, we've been telling our members all along, with all the stocks that we've been long, keep taking profits into the rally. Keep taking profits into the rally and reset your stops because this could end any time. And we've been saying that over and over. Because again, the market, I can go up to 6,200 until the retail investor runs out of dough because it's the retail investor that's pushing up the money, the market rather, because he's the one who's out there borrowing, going to debt, and he's buying stocks on dips, especially tech stocks. But the problem, he doesn't understand, the retail investor doesn't understand what's going on. And what he doesn't understand, without the participation of the institutional money, it's hard to keep above the trend. And that's what's been happening here. I'll show you what I mean. See if I have this up here for you. I'll bring it down. Now, the trend line that we've had, let's see if I don't have it now, I'll push it up later right here. Here it is. Okay, here's the trend line right here. Now, if you notice the trend line, it's broken. This S&P has broken the trend line way back in August. And look, every time it's been rallying, it pulled back, make another high, okay? Then rally, pull back, make another high, pull back, make another high, pull back, make another high, and it's pulling back again, it'll make another high. But you notice these red dots, it's not able to hold that trend. And you can see back here where the S&P was holding its trend. What is the difference? Why could they hold the trend back here but can't hold the trend now or since August? Because the institutions aren't participating. The institutional money don't want to be in this market because they're smart. That's why they're called smart money. And without them participating, as I said, the retail investor, he doesn't understand. So the reason they're not participating, one, IWM. IWM is one of the best signals that you get in the stock market when there's a problem. It's forward-looking. Remember how the market works? It's always forward-looking. Sorry. Just like when you get Walmart yesterday, right? Nobody cares about their earnings. It's always about what are they going to say, how are they going to be doing going forward. What do they say about forward earnings? What's going to happen? And they disappointed. And that's why Walmart went down. In fact, when you are looking at earnings season, that's all you need to really look at. Everything else is just noise. Just listen when they start saying, how are they going to do going forward? That's all you want to know. Now, the institutional money knows going forward is not going to be good. And they know when they look at IWM, and I'll put it up here for you, and you'll see what I'm talking about. IWM is a small and mid-cap stocks. They're everything. They tell you everything. So here, take a look. So if we go put a chart up for a year, let's go and take a look at the diamonds. Here's the diamonds. Okay, they had a beautiful rally and then stopped back here in December. And they've just been going sideways. Now they're pulling back. The spiders, beautiful rally. Look at this. For the last year, stopped in December. And we've just been going sideways. And every time they try to break out, pop out, there's not enough firepower to break out. Why? Because the institutions aren't participating. Now, and here's what I mean by that. Let me bring this back to 3 months. See what I'm saying? So back here in December, everything stopped. We had this great rally up to December. Everything stopped because the institution said, And every time they've been trying to break out, it keeps failing. Here, see the last breakout? Now it's failing again. Now, we can go right back up again. If the retail investor has enough money left, he's going to come in and buy every dip until he can't. And that's when the crash. Look at the difference. Let me put it back over here. Look at the warning we get from IWM. But very few people understand what even IWM is. They think it's a song. No, it's not a song. Okay, those are the small and mid-cap stocks. It's the heart and soul of the business, of the economy. It's our small businesses. Okay, it's the mom and pop businesses. It's just everything. So, and no one is looking at this. And as I've been saying, yes, we can go to 6,200 on the S&P, but take a look at your IWM. That's your warning. Now, here's the other thing that's going on, why they're not participating. IWM. Another reason is institutions aren't willing to pay the crazy valuations. The PE ratios are insane. What are you, nuts? They're not willing to, now remember, a PE ratio, if you don't know what that means, it's the value. What is what investors are willing to pay for each dollar of earnings. So today, they're not willing to pay for the S&P 30 times higher than its earnings. What are you, nuts? When it's historically half that. And that's the same problem with the Qs, the same problem with the net. I mean, it's the same problem with the diamonds. They are not willing to pay these crazy valuations. So that's a big problem. Another problem is inflation is on the rise. We've been lied to all along about inflation. It's been bad. It's been going up. It's still going up, inflation. They know that, the smart money. What are they going to do? Go back to zero interest rates again? Not going to happen. Now, the problem is this administration, the last administration, was not willing to do what Volcker did. He came in over 2 years, he raised interest rates from 11% to 20%, and he got rid of that money that was in the system, all that money supply. Remember, when you print a tremendous amount of money, here, let me show you what I'm talking about. When you print a gobs of money, I'll put this up and show you. Grab it here. Here you go back to 2009. When the market crashed in November 2008, by 2009, they were increasing the money supply big time. Big time. And they kept printing money, called QE. Fed dropped their rates to zero, so they could loan the money to the banks at zero, and the banks could loan to public corporations near zero, so they could buy their stocks back. So the Fed has to also make sure that the long-term rates, like the 10-year Treasury rates, are down too. So they print, and they go in and buy all these treasuries to get their yields down. So from March 2009, or November, let's say go November 2009 to May 2022. No wonder we had a hell of a rally, because rates were at zero. But what did that do? That created $14 trillion worth of printed money. That's all inflation. So you go back from March 2009 to May 2022, rates were at zero. Then from May to, then it stopped. Remember, May 2022, zero was over. And then we went from then to 5%. So we went from zero to 5% from May 2023 to September 2024. About 16 months, we were at 5%. People forget this. Then it started to drop, where we are today, about 4.2% or 4.4%. So the problem is, all this rally we are involved with is at rates near 5%. The biggest rally we had was from November or March 2009, okay, to let's just use to 2022. Of course, because it was zero interest. But now there's a problem. The institutions know this. What they know is that we can't do that again. We can't start printing today and say, let's go back to zero. That's why rates have been going from 0 to 5% since May 2023 to where we are today. And now they're pulled back a little bit from 5%, but they know they can't print money and go back to zero interest rates, start QE, and Apple would be $100. But there'd be no farmer that could make the app, create the Apple. There'd be no truck driver who could afford to truck them. In other words, we'd be out of business all over the country. Nobody'd be working. So now they got a problem. We got high rates. How do you get them down? Now, yesterday was interesting. Yesterday, finally, the truth came out. Yesterday, the bank stocks dropped. Why? Well, they were worried that their biggest profit centers, investment banking and interest income, are going to get hit. Now, if you remember the last time that we had earnings season, and the banks always report first, I remember the banks said, oh my God, we had a great earnings, And they said it was because of the loans they were making to the consumer, loans they're making to Main Street. And I said, that's a lie. They're always their biggest profits come from investment banking and interest income. Well, why are they lying? Well, we found out yesterday because the banks now, okay, they know that with interest rates going back up, and if Powell comes in and starts cutting rates, let me tell you, they could go back to zero if they're stupid. In other words, who controls these rates? Is it Powell? No, it's Wall Street. It's not the 1%. It's the 1/100th of 1%. The very, very wealthy. Remember, they make their wealth on assets. Let's take Pelosi. She's one of the 1/100th of 1% as opposed to the 1%. So on her artwork went up, what, 30%, 40%? Her vineyards went up like 60%. These are called the asset class. They make a fortune when inflation's going up. So they have put us in this position since March of 2009 to where we are today. They made a fortune from 2009 to May 2023 when rates were at zero. All that inflation, because they had to print all that money to buy 10-year treasuries to get the yields down, to go down with the Fed yields. So could they turn around and say, you know what? We don't care about Main Street. Do you think the 1/100th of 1%, the people that control everybody and everything, you think they care about Main Street? You think they care about the person who's making $65,000, $70,000 a year, has 2 kids, and is working paycheck to paycheck, can't make it? They have 2 jobs. The wife never sees the husband never sees the wife. They're working. You think they go, oh, gee, this is bad. We shouldn't do that. No, they could turn around and do this. But I don't think they're that stupid. Especially with Trump in office, I don't think he'll allow that to happen. So let's talk. So yesterday, they were worried that Powell is going to cut rates, go back to zero, and that would kill their investment banking. That would kill their instant income. That's why the banks are down. And we own the banks, but we've been taking profits all along in the banks. In fact, if you take a look at our banks, we told everybody to keep taking profits. You got to keep every time these banks rally. You've got to take profits, because if you don't, you can get caught because of what is going on. So our bank stocks, if I can find our bank stocks. All right, let me get back down here. Oh, I'll tell you another one we did well with, our Johnson & Johnson. Look at that. And now what you should be looking at is stocks that have relative strength. When the market's going down 777 points, you want to make sure you're in the stocks that are going up. That's called the relative strength. Another one we're doing well, look at our gold, great relative strength. In a market that's going down almost 800 points, our gold's going up. Our UNG, gas, we're in gas, natural gas, that's going up. Our AT&T, look at this, that's going up when markets are going down. Starbucks, we're in Starbucks, that's going up. So that's what you have to be. And also we're in, super micro computer, SMIC, SMCI. And look at this. So now going back to banks, the banks got hit yesterday, see it? But again, we've been telling our members all the way up, make sure you keep taking profits and resetting your stops. See, most people don't do that. They get greedy. Now, the banks could turn around and go right back up. And I'll explain when I get back from the break why they can go back up. But the question is now, who's going to be the leader if they don't? Who's going to lead this market? We'll talk all about that when we get back. Join my gang, Phil's Gang.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When making wise investment decisions, Phil Grande has some sound reasons you should join Phil's gang.
You know, when I started this, they asked me, okay, can you explain to people why they should join the gang? Gee, I thought about that. And I guess to make money. But more than that, to get good direction on which way the economy's really going. We get so much crap, so many lies, how great the economy is and how great the tech business is, and when it's not. The problem is we have too many people in Washington and in this industry that just don't tell the truth. The truth is everything. And here at Phil's Gang, we stick with the facts. We tell the truth. We make sure our members, are getting the best information, and our listeners, like you. We make that information available to you and make it simple and understandable.
Good investing means understanding how the stock market works. Join today at philsgang.com. Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
And welcome back to Phil's Gang podcast radio show. Also, let's talk about, again, these banks. Because the banks is what drives the stock market. It's the banks. I know everybody thinks it's the tech stocks, but no, it's always the banks. They're the leader. Without banks, you got nothing. Now, what was interesting is, I hope that the president gets rid of the Federal Reserve for this exact problem we had yesterday. Think about this. We never get the straight dope. We always get noise, not good information. Example, when the bank stocks dropped yesterday, the CEO said of the banks they were worried about the investment banking getting hit, interest income getting hit because of the yields, and they also are worried about, of course, inflation. And they're worried about Powell may turn around and take orders from his bosses, the 1/100th of 1%, and tell them to drop rates back to zero. That would kill their investment banking, interest income, but we'd be short, so that'd be good. But Powell contradicted this. A few weeks earlier, he told the Senate, the committee, banking committee, just the opposite. He said, we have a pause on rate cuts. A pause on rate cuts. Are you kidding me? And he said, because consumer prices have been rising since September 2024. He told them retail sales are going up. Are contracting. Retail sales are going down. People don't have the money. They're going down. They've been contracting since December 2024. And inflation, look at the CPI last week, has been coming in hotter than expected. So Powell told the Senate there's no rush to cut rates. So why would the banks be worried about rate cuts? And why would they sell off then? See, because it's noise. If you believe Powell, what he said to the Senate, you're nuts. You can't believe anything. It's called noise. You gotta believe, where is the money going? If you follow the money, and I know 25 years ago, when I was trading, one day I said, when I look at my chart, a regular chart, it's always, one day it's green, next day it's red, next day it's green. Why? Because they want to let you know if the stock that day closed on a high or a low. I said, unless you're a scalper or a day trader, who cares? I want to know, where's the money going? I want to follow the money. What sectors are the money in? We check that every morning. And again, we could see clearly what was going on, okay? That we knew that the money, okay, that all the money was going into one place, okay? It was going into these banks. And everybody was getting out of the tech stocks and following the money into the banks and follow the money into gold. Now, again, the problem is with the Fed, they gave everything you hear from them is total noise. Why would Powell say the exact opposite that the banks are saying? So what do? Should you be in the banks again or get out? No. What will make that decision for you is the money flow. Is the direction of the money. If it's green, money's going in. If it's red, money's coming out. So again, the other thing, Walmart yesterday, they dropped because of a lousy forward guidance. Here, I'll put Walmart up. Walmart had dropped because of a lousy forward guidance. Look at that right there. Again, another lesson. They reported, and we had every one of our members out of this. We've been in Walmart. We've done beautiful at Walmart. But when you have earnings reporting that day, you make sure you're not in that stock. The worst thing you could be is in a stock when they're reporting earnings. And a lot of people will do that, and they get hurt. Now, every once in a while, they get lucky. The stock goes up big, and they're heroes, and they feel great. And then the next time, they're going to do it again. And the next time, they lose all their money. Never, never do that. Never do that. So, again, with the other problem that the institutions realize is this, right here. Look at the debt. Look at the debt from 2021. This is credit card debt. From 2021 to 2024, 1.2 trillion people are buried in debt. And a lot of people these retail customers are using their credit cards to trade stocks. They all think they're going to get rich because here's what the average retail investor never experienced. He didn't experience the dot-com crash in 2000, 2001. He didn't experience the financial crash, 2008, 2009. Most didn't even experience the COVID. And if they did, that was bad because when COVID took a hit, what happened? Immediately, bang, they dropped interest rates to zero to push those stocks right back up. And what they think is now, even if the market comes down, who cares? It's going to turn right around and go right back up because the Federal Reserve is going to come in and lower rates. They're going to print all this money and lower it. They can't do that anymore. Not unless, of course, they want us to pay $100 for an apple. But look at this. It gets worse. This is why the institutional money, why you follow that money. Always follow the institutional money. Now look at this. Let's go back in time. Let's go back to 2008. Here, this is the percent loan balances, 30-plus day delinquent. So look at the delinquencies right before the crash in 2008. Look at these delinquencies. Are you kidding me? Look at the credit cards. I just showed it. Look at this. And as soon as they peaked, bam, we had the crash. As soon as the auto loans peaked, we had the crash. As soon as mortgages peaked, we had the crash. Guess what's happening now? The same thing. It hasn't peaked yet, but they're on the same flight path. Look what's going on with the credit cards, going straight up again. Auto delinquencies going straight up again. Mortgages going up straight again. I mean, it could be 6 months, 7 months, but they're going to peak out. So we're heading in that same direction. The institutions understand that. They're smart. They're the smart money. They're not in there buying on dips. So again, it's all about, hey, how about following the money? Because that makes a big difference. Because if you're not following the money, you're really screwed. And if you're listening to these people on these financial shows, you're doubly screwed. Okay, so what do we do? Well, first of all, let's look at why is it the fact that yesterday, again, think about the Fed. Yesterday we were told, okay, that by the fake business news network, we were told that yields were dropping. Interest rates were dropping. Everybody got all excited because of the peace talks between Ukraine and Putin. If you followed the money, you know that wasn't true. What was true is the Fed's balance sheet. It has a big problem. See, the Powell, or before Powell, and starting in 2008, 2009 with Bernanke is when they started doing QE, and they had those interest rates at zero, okay? Going from 2009 to 2022, That's tremendous inflation. So the Fed balance sheet, when they were done right before COVID, they were pretty much done. They had about $4 trillion of these 10-year treasuries they bought. Remember, they bought $4 trillion worth of 10-year treasuries to get the yields down to follow the Fed rate down. Then COVID hits, and they started to crank up again. COVID comes in, what do? Print money, and they doubled the amount of purchases of treasuries. They went from $4 trillion to nearly $9 trillion, or they did. They hit $9 trillion. They more than doubled. Now, when you have all these treasuries, the Fed, sitting on its balance sheet, there's consequences. They don't want you to know. And that's why, again, the market's going to crash. But nobody, every time I say that, anybody that's been in this business as long as I have, and they're telling people, hey, look, I'm warning you, this market's going to crash. Because people have been in the market as long as we've seen it. It's the same thing over. They all crash. They all may have a different reason, but it's all the same thing. Money stops going into the market by the institutions. And when institutions stop putting money in the market, you're screwed. So the Fed's balance sheet's sitting there now with $9 trillion. What are the consequences of that? Are you kidding? It shrinks the money supply. The money supply, it shrinks it. Why is that bad? Because if you shrink the money supply, what happens with the market? It gets volatile. Do you think our market's volatile? Also, what it does, it makes it harder to fight inflation when your money supply is shrinking. Another thing, and nobody's going to tell you this stuff. They don't want you to know this. And it also hurts small businesses. They can't get a loan. They can't borrow. Because who's doing all the borrowing? The government. So they crowd small businesses out. And when you crowd out small and mid-sized businesses, the economy's screwed. They are the economy. So it hurts small businesses, mid-sized businesses. That means we don't produce. We don't need the jobs. We lay people off. Job openings tank. And what keeps our country going? A strong labor market. That's where we are. But nobody's going to tell you that. He doesn't know what he's talking about. It's just going to keep going up forever. Well, it's not going to keep going up forever, believe me. So I just want to show you a couple things here. If you look at, and I'll show you this, if every day, just remember this, that the banks are the leaders, because banking's everything, okay? Now, remember, until the banks, XLF, until it breaks through what we call on our chart, our stochastic, 80%, the banks have a high probability of still going back today. That's right, they still can go back. If you have JP Morgan and you're in JP Morgan, don't panic. Take profits, take the profits, and then make sure you put a stop in. But don't panic, because guess what? Because JP Morgan can go right back up. Why? Because look at my Pro 2 color-coded chart. It's still green. It's telling you there's still more buyers than sellers. That's the beautiful thing. That's why when you have your generic chart of red, green, red, green, red, green, what the hell does that tell you? Nothing. But when you have a chart that tells you when money's going in and money's going out, that really helps you. So again, if the stochastic, the red line on the stochastic, if it doesn't reach 80%, if it doesn't break to that 80%, then you have a high probability of these banks going right back up. The minute they break through 80%, here, let me show you what I mean if you're watching. The red line of the stochastic right here. See this red line right here, that red line? If that red line now drops over and breaks 80%, this will turn, your bank candlestick will turn red. Not yours, because you got the generic type. But mine will turn red. Then when it breaks through the white dotted line, that tells you this trend. You see this trend right here going up? The trend has been destroyed. So what it does, it tells you, okay, it tells you that, look, with all certainty, your trend is now broke. It only has one place to go, down, because the big institutions are pulling their money out and they're shorting. That's the beautiful thing about this chart. But my point here today is if that doesn't break through 80%, that doesn't turn red, you still have a high probability of the banks going back up. If the banks go back up, then the market still can hold its march to 6,200. So when I tell you the market is going to crash, it is. But don't hold that against me. Say I'm wrong and never crash. As long as they keep printing money, and as long as they keep on shoving money and keep increasing the money supply, they can continue to push this market up. But the problem now is that the institutions aren't participating. So how long can the retail investor keep borrowing money? I mean, he's borrowing money like crazy to buy stocks, especially tech stocks, because he thinks he's going to get rich every time they go on a dip. The minute he runs out of money, it's over. Now, how do we know that? Well, we already know that because of IWM. So the sectors that you really need to watch and follow is your information technology sector, XLK is the symbol, your telecom tech, okay, and it's IYZ, and one more, the consumer sector, which is XLY, like Amazon and Tesla. Watch those sectors right there. And if they continue to go down, you're going to have the crash. Don't look at all this other stuff. That's what you got to watch. That's where most of the institutional money is going, but not now. That's the problem. That's the problem. I hope I helped you. Join my gang, philsgang.com. Check it out.